Where is everybody? Anyway, I'll check the guys can hear all right before we start. Is sound okay over here, or do you want a bit more? You okay for sound? I think that's a nod. You guys okay for sound? You guys at the back okay there for sound? Yeah, fine. Where is everybody? They have an exam. Oh, I see. Right. Okay. So it's a good day to give you a bonus question. Right, has it clicked over? Yeah, it has. Okay, so we're still on the topic of the regulation of the financial institutions, and we'll just review basically what we did last time, and then we'll progress on. There's actually not a lot left in this section, so it's likely that we'll get to the end of it before the full hour is up. So most of the last session we were talking about bank capital, basically in terms of its purpose and then also what it actually is in terms of the regulations. And one of the things it's there for, in fact, the primary reason for having it is to absorb unexpected losses in the value of the assets of the banking's, the actual banking business. So these are just the risks that are inherent in running a banking business. There's nothing additional on top of that. And what it does, it provides protection for, primarily what they're looking for is protection for depositors, but also for other creditors, ones that may have bought money market securities or bonds from them, so that the losses essentially are absorbed by the owners of the bank rather than people like you and me who are depositors and customers of the bank. So that's what the bank capital is supposed to do in terms of its function. Now, what actually counts as bank capital is largely defined by the Basel Accords. Now, the Basel Accords are an international agreement between member countries of the Bank of International Settlements, of which New Zealand and Australia are part of that. And the Basel Accords have been in effect for almost 30 years now, and we're on the third series, or what we call the Basel III agreements. And so both what can be counted as capital, and also the minimum requirements are specified in that international agreement. And both New Zealand and Australia have been fully on Basel III since 2013, although the actual Basel III agreement was concluded in 2010. So one of the key things that is required in that in terms of measurement is that you have to report to your regulator what's called a capital adequacy ratio. In a simple ratio, at the top you put how much capital you have, and you work out how much you have using the Basel guidelines, how they are allowed to calculate, what you're allowed to count. And then you divide that by not the assets, but the risk-weighted assets that you have, and that comes out to whatever you actually have. But there are minimums specified, and currently New Zealand is requiring a minimum of 10.5% or more in terms of your capital adequacy. So once you do the calculation, you've got to have a number that's bigger than 10.5%. As long as you're above that, you're fine as far as the regulator is concerned. Now, the capital itself, when we go to look at how it's calculated, what can be counted, there are two tiers. One's called Tier 1, one's called Tier 2, not very informative names. But the thing that makes them distinctive is the Tier 1 capital is available now for immediate writing off of losses. So if you have losses in your assets, they can be immediately written off against Tier 1 capital. And so when there are losses there, that's where it gets hit. Now, you are allowed what's called Tier 2 capital, and what is actually counted as Tier 2 capital sometimes is debt, so it's not actually capital in the normal sense we would understand that word. But basically, when you look at what constitutes Tier 2 capital, the defining feature there is that this is not immediately available to absorb loss now, but you could probably get hold of it over some time in the future. And a good example of where that might occur is if you have issued convertible notes, and they are mandatory convertible notes. That means that they have to be converted to equity at some stage. You may find in the structure of the note that they only have one chance per year, where they can do the conversion. And so you can't actually use that, even though it's counted as capital, until such time as the conversion is done. And so Tier 2 capital is stuff that, at least from a regulator's point of view, is lower quality, because while it will become available or can be made to be available for absorption of losses, it's not available now. But given the right circumstances, you can call on that. And what we found in the crisis is that often you couldn't call on it fast enough. Now, when we looked at trying to figure out how much they needed, the ratio is on the top, capital you have, but on the bottom is the risk weighting of the asset, risk-weighted asset. So it's not the assets you have as a bank. You have to actually individually risk weight each asset, and then you sum what is the risk-weighted asset. And the basic reason for doing this is that basically not all assets have the same probability of default. And so in terms of deciding what risk rating is important, there's two factors. What is the probability that this particular asset will default? And then the second part of that is, if they default, how much am I, as the bank, likely to recover? And so we can have very low risk assets like a government bond, which is often risk weighted at 0, because we tend to assume that a domestic bond from the government will not default. But then if you go to something like a mortgage, which is obviously more risky, there's not only a question of what is the probability that this mortgage will default, but in the event of default, how much can I recover? And so if you've got a first mortgage and a very low loan-to-value ratio, then you can be relatively sure that you can recover a lot. And so those types of mortgages tend to have a low risk weighting, and you simply, in terms of the calculation, weight everything by the risk, add them all up, and then that's the number that goes into the bottom of that calculation to calculate your risk weighting, risk-weighted assets that you have. Now, in addition to that, we talked about these other things that we call the off-balance sheet, either assets or liabilities. They're what we call contingent asset or liability. And you also have to hold capital for those. And a good example of where they might have a contingent asset is, remember in the money market section, we've talked about how often a bank will be called upon to provide a line of credit to ensure that the commercial paper, that at the end of maturity, commercial paper, it can be repaid. And so when they go to the bank and get the line of credit, they actually don't draw any of that money down. And under normal circumstances, the company that is issuing the commercial paper will repay it themselves. And so let's say it was backing $100 million worth of commercial paper. That $100 million is not on their balance sheet. It's off their balance sheet. But the thing about it is, if it's drawn down, then it will become a loan that the bank has made, and it comes onto the balance sheet, and it becomes a real live asset for that point. And so, because often this is what they do as part of their business, they will grant loans, and only those loans may be partially drawn down, but more drawing down. They have to hold capital against those things, basically making provision for the future. And then you might have asked the question now, does all this risk weighting stuff make much of a difference to how much they actually measure? So most people don't know these things exist, but pretty much every bank is required on a semi-annual basis to release to the general public a basic statement of their financial health. Most people don't even know that they do this, but this is the one. This is the most recent one for the ANZ. And what we have down here, when they're calculating, it says, capital requirements for the banking group, and this is for the ANZ. They give you the exposure here, and then they give the exposure there after the risk weighting, and then how much capital they have to hold according to the statements from the Reserve Bank. So you can see that the risk weighting does actually make quite a bit of difference. Like if you look at here at corporate exposure, they got almost 50 billion in corporate exposures, but after risk weighting about 32 billion. Sovereign exposures, that will be to some sort of government debt, may not necessarily be entirely New Zealand government debt. They got nearly 13 billion in that type of asset, but after risk weighting, it's only 300 million. So big reduction there, supposedly because these are low risk. taking mortgages, again, they've got nearly $75 billion in mortgages after risk weighting, about $17.5 billion after risk weighting. So when you add up all this other stuff, what they come with, their total assets, $177.5 billion total assets after risk weighting, about $74.5 billion. And that's a reduction of almost 60%. So the risk weighting makes a big difference to, if you think of, capital on top, risk-weighted assets on the bottom. If you can shrink the total assets down by 60%, which they do, by risk weighting them, then the necessity to hold capital, goes down. And so by their calculation, they should have a bare minimum of about $6.8 billion in capital. In actual fact, if you go up here, they got total about $12.3 billion, of which $11.8 billion is Tier 1. So they are well above the regulatory minimums here. But we can see that this risk weighting here does make a big difference to how much they have when they make that calculation, because it shrinks it by almost 60% in this case. Okay, so that brings us basically to this point here. So these are some other risks that they face and have to hold capital for. So what are operational risks? What are they? Management. Anything else apart from management? No? Okay. There's a number of things that can go wrong in your business. That's not necessarily good things. Here's a lineup of, oops, oh my gosh, what happened? How do I make that go back again? Like that, right, good. Okay, so for example, if you get a trader in your bank who starts misbehaving, and there's been a number of these over the years, they can cost you a lot of money very quickly. Credit card, there's always people trying to steal your credit card, either online or in real life. Things like natural disasters and terrorist attacks, if you had something affecting your business that way, you have to hold capital for these sort of things. And the bottom point there about technological advances, because most stuff throughout the world is now connected by speedy networks, hackers and those sorts of people are quite real menace here. So that's what they are. And then, of course, what you have to do is somehow turn your assessment of those types of risk into how much capital you hold. Okay, so I'll show you what ANZ does in just a minute. So what are market risks? Go to the second one. What's a market risk? Yeah, go ahead. So many of the assets they hold will change in value particularly in response to changes in interest rates. And say, for example, they hold some bonds and interest rates change, then the value of those bonds will change, and you can actually see exactly what that change is in terms of price on the market. So anything that they are holding that has a market and the price can fluctuate up and down, that is the thing that we call the market risk. And so they can sustain losses on their assets they hold that are subject to these types of risks. And if you've got a fixed or slow resetting loan and interest rate change, the value of that loan changes. Foreign exchange, obviously, if you're holding foreign exchange because currencies, because you're a dealer, the value of those currencies can change. And of course, they're big derivatives dealers, and as to enter into derivatives context, they can both gain money and lose money. And there's various complicated ways of actually calculating these requirements, but we don't go into them here. So just looking at the ANZ and the most recent document, we've got the operational risk is here, and then below it is the market risk. And their assessment is they've got about $6 billion worth of operational risk and about $5.2 billion in market risk. And then this is their calculation over here of how much capital they should hold. And between those two things, they hold about they're required to hold about 900 million in capital. So, we don't go into details exactly how they come up with these numbers, but when you look at an operational risk of $6 billion, it's actually quite substantial risk that they have there. And same with the market in terms of the assets they hold, that it can fluctuate with the market. They estimate their risk at around 5.2 billion. So it's a significant chunk at risk there. Now, anyone want to ask a question on this before we go to the next slide? Yeah, go ahead.
Just wondering if for this operational risk is included natural disasters. You told us before that there's a kind of a pure risk. Then normally that if you want to prevent the pure risk, they normally buy insurance. How come they ask for the capital for this kind of risk?
Yeah, it would say natural disaster, like, say, for example, your communication network got knocked down, say, for example, because of a electrical storm. That puts you out of business for a while. And it's true that, for pure risks, what we do is we tend to buy insurance, but when a company faces one of those risks and it actually comes to get them, like, communication networks being knocked out, the local branch is basically down because they can't communicate with the central computers, then the operations of their businesses stop for a while. Now, hopefully, if they've got the right type of insurance, they'll recover that down the road. And again, if you get some terrorist attacking one or more branches, those branches will be out of business, and of course you don't make money while they're out of business. And it takes a while to restore that. Sometimes for some of these risks you can buy insurance, but often you don't get that until sometime down the road. And in the interim, your business is actually stopped, at least partially.
So do they buy insurance for this kind of thing?
Yep. I mean, if they own their own premises, they'll have fire and flood insurance and all that, earthquake insurance, all that sort of stuff. They'll buy insurance. Any other questions? Now, even though we've updated the Basel Accords quite significantly in recent times, they're not without their problems. And so this little slide here is just, it makes what's actually quite an important point within finance, and that is, there are lots of models in finance for all sorts of things, but often what we find is that simple models tend to work better than more complicated ones. They're not always like that, but in general, that's a principle that seems to apply quite widely. Simplicity is better than complexity, and so if you think about all the complexity around the weighting of the risks, what you can count as capital and what you can't, and all that sort of stuff, it's a very complicated system, a lot of calculation to be done to come up with the right numbers. But what we've seen in the past, as banks have failed from time to time, that the simple, not just capital, but just plain equity to total assets, if you take that ratio, that over the last, 30 or more years, actually 60, particularly since Basel II, when they started doing this, it was 2004, that this simple equity to total asset ratio is actually a better predictor of financial strength. Basically, look at the other way. If it's low, the probability that the bank is going to fail is higher. It's better than the Basel measures. And this is the basic problem. And this is actually, I've read this in various things from central bankers, that the risk-weighted measures only seem to work as long as you don't have a crisis. Or put it rather cynically, the risk weighting works only when you don't need it. If you don't need it, it's fine. As soon as you need it, it doesn't work because they don't actually measure the risk properly when we hit a crisis, and that's the basic weakness in these things. And there's plenty of people who, even in New Zealand, within the banking system here, who particularly say that this one here, retail mortgage exposures, does not have a high enough risk weighting. They say the risks are significantly higher than the Basel Accords say they are, and ultimately, when you say how much capital, think about it, almost $75 billion in mortgages, and they got 1.5 billion required capital for that, there's many people who say that that's just not enough. The risk is not measured properly. And if you get a meltdown in the property market, then these banks will be hit by this. Now, I did do the calculation on this one. Now, I can't say this is exactly right because this doesn't split out the things that are off balance sheet from those that are. But if you just take their total credit risk, that's the 177.48 billion, and put on top of that the 9.028 billion for their actual equity capital, you come up with a 5.1% ratio. Okay, so on the simple measure, they have a 5.1% capital adequacy ratio, but by the book, here is their one for the most recent statement. They got a 14.3% capital adequacy ratio. So by Basel III Accord, oops, hang on, sorry, I'll pull it down. Yeah, you can see it there. Total capital, there's the ratio there, 14.3%. And so that is, by anybody's standards in the world today, a very strong bank. But when you start to look at it in the simple terms, equity versus assets, it's around about 5.1%, which is lower than the 6% that was in Basel I. Okay, any questions on that before we chug along? Okay, move along. So there are other controls on banks and other financial institutions. So this list of 6 here, the authorization of banks, ownership, control of banks, association with non-banks, board certification, exposure limits, and external reviews. We'll look at these in the next few slides. So that's the 6 that we'll go through. So they're not just looking at liquidity and capital. They're looking at more than that in terms of running a financial institution. So if you actually want to start a banking business, you think this is a good idea, you think you can make some money at it, you have to get a banking license. And that's the same both in New Zealand and Australia. You have to go and apply for a banking license, and they'll go through a thorough check before they actually grant you a license to operate a bank. So the upper side is this. So first of all, you have to put in at least 50 million in capital. Okay, so that's to get you started. Then it allows you, take deposits and that sort of stuff, and then go and make loans and stuff. But that's your bare minimum to get yourself going, and then hopefully, if your business is successful, you'll grow that over time. The second one about compliance with legislation is kind of obvious. You can't break laws while you do this. Now, the third one is maybe unexpected because there are very few cases. In fact, I don't know of another case where there is a regulatory authority that has to approve your board of directors. Now, there are some legal conditions on board of directors. Some people can't serve, like, for example, if they went bankrupt, they can't serve as a board of directors on a general company. But there's no regulatory authority on any other sector that I know of where the regulator has to approve your board of directors. Now, both New Zealand and Australia, it's actually written in a negative way. Basically, what you have to do is the regulator, in this case APRA, has to not object to the board of directors. So if they look at your board of directors or your proposed board of directors when you're starting your business and they say, I don't like that person, you can't have them, then they can actually stop a person from sitting on your board. And when you're going down a bit further into the senior management, it's exactly the same thing. They have to not object to the people that you have in the most senior levels of your organization. When you're getting started, and this continues after you've got going, is that they have to approve your risk management systems and your internal controls. So you can't just have anything you like. You have to have one that meets the requirements that they impose. Fifth one, external auditors. Again, you can't have any old auditor. You have to have an auditor that's approved by the regulator. So you can't get the cheap guy down the road. You have to go to a good auditor that's been approved by them, because as part of the regulatory process, any audit report made by the auditor not only goes to the bank, but it also goes to the regulator. And the final one there if it's a foreign applicant, okay, someone else from outside, say, typically what happens in these sort of cases is a foreign bank wants to open up in Australia, and it's the same in New Zealand. Foreign bank, say, wants to open up in New Zealand. Not only do we have to approve them here, you have to get, as part of that approval process, is have approval from your home regulator. So if a bank wants to start up here, they have to have approval from the home regulator before they can start. And that just serves as another layer of protection. So again, that's simply to try to make sure these things are run well, and they're not going to cause problems either for their customers or the rest of the systems. Now, the names such as like bank, building society, and credit union are actually legally privileged. You can't use these names if you're not one. So in terms of the ownership, this is the exclusion. An individual or a group shareholding cannot exceed 15% of the voting shares. So you can't go out and buy a huge stake in a bank without falling foul. Why would a regulator be concerned about someone having more than 15% of the shares on issue for a bank? Yep, go ahead.
So that they can, just from the previous slides, they can just kind of it's easy for them to regulate the institution. If the voting rights is over 15%, then it's going to be hard for them. Like, for example, appointing the board of director, something like that.
Okay, so in terms of what you said, in terms of the board of director, with that large amount of shareholding, often you can have a director on there. So your own director on the board of directors. And so one of the reasons that they're concerned about with these large shareholdings is because of the economic power of a bank, that a large shareholder, because they're part owner of that bank, is that they can direct the bank to their own financial gain. And if you can put a man or woman on the board of your own choosing with this type, and typically you would get one with this size, then you have an influence over the bank, and you can have the bank behave in a way that benefits you as the owner, to the detriment of other owners. So they don't let people have more than that. In fact, they can waive this and make it smaller, and make it bigger, but they can waive this and make it smaller. If they're concerned about certain shareholders having too much power, they can actually reduce it below 15%. But 15% is the upper limit. Okay, equity associations. So basically what they're doing there is they're buying less than the entire business. So let's say, for example, they go and buy part, say half a business. Now, the type of businesses that they can buy into are expected to be other types of financial institutions. For example, insurance, wealth management, super funds, and those sorts of things. Those are the types of businesses that a bank can buy into, and say, for example, if it, say, took a half share in some sort of, say, it didn't have KiwiSaver offerings of its own, and then it bought a half share in a KiwiSaver company, and then they could promote those. That's how they promote their KiwiSaver. That would be this type of association. So say they didn't actually own the thing outright, but they owned a good chunk of it. And so there are limits on how big this can get. Okay? So on a per association basis, it cannot exceed 50% of Tier 1 capital. So if you looked at the ANZ and how much capital it has at Tier 1, it's got about almost, well, not quite, we'll say it's 12 billion. You can't spend more than $6 billion on a partial acquisition of this type. And if you have more than one of them, you can't have more than 150% of your Tier 1 capital in all of these. So if you buy a wealth management, a life insurance, a general insurance, and a finance company, and so on, you can't have more than 150% of your Tier 1 capital tied up in them collectively. And there's also limits individually of 50% in any one case. So why would a regulator be concerned about that? All very quiet. Well, think back to the equity section. You think, what happens to the equity holders if the business goes out of, goes bust? I mean, there's people like government for taxes, employees that deserve their wages, secured creditors, unsecured creditors, preference shares, equity. And basically, if a company goes under, typically the equities holders, because at the very bottom, receive nothing. So in the event that something goes wrong in the business and the business loses value, then it simply erodes your capital because you're down the bottom there, final lot, and you take the hit. So they don't want them doing this in large amounts because it exposes large amounts of their capital to vanishing and if something goes wrong in this sort of situation. So your board of directors, so we talked about that just a few minutes ago. If you're starting a banking business, once you've started that business, this certification of the board of directors continues on. So what they're required to do is that the board of directors essentially require to certify the efficacy of the risk management system. So they have to essentially sign a document that it goes up to their regular on an annual basis, saying that the internal internal risk management systems of the bank are efficient and will handle the threats that the bank faces. So it comes at the very top. It's got to start. It's got to come from the CEO. He has to sign off on it. It's got to go up to the board of directors, and they have to sign off to it. And at that point, that certification goes up to the regulator. And again, this occurs on an annual basis. Again, just part of their routine monitoring. And if a bank gets into trouble, then they can up the frequency of reporting if necessary. But normally, if the bank is fine, annual reporting on this one. Okay, what about large exposures? What are large exposures and why would they be concerned about them? What's a large exposure? When we talk about large exposures of banks and other institutions, what are they? Yep, go ahead.
Just basically how much you can lose out.
Okay, essentially that's it. Yeah, if you make a loan, it's basically how much you can lose, and basically what they're concerned about here is large loans. And that's simply because you can lose more on a large loan than a small one. And so there's actually a specification of how much you can actually make a loan of. In terms of reporting, we've got down here, quarterly reporting. So every quarter, you report to your regulator how much you have of these things. But you must report new exposures greater than 10% of your capital base. So in terms of the ANZ, with a capital base of about $12 billion, if they make a loan bigger than $1.2 billion, they have to then put that in their reporting to the regulator. Now, if they're going to go for a really big one, 30%, they can't make that decision on their own. They cannot decide to make a 30% of their capital base loan. So in the ANZ case, we're looking at about $3.6 billion. They can't make a decision on their own to make a loan of that size. So they actually have to consult the regulator, and basically, as I think the way it's worded, it's sort of in this non-negative way, the regulator must not object to them making this loan. So it basically gives the regulator the power to stop this in these very large cases, because simply the bigger the loan, the bigger the chance. Well, if you do something goes wrong, the larger the loss. And so they'll look at these quite closely if they're going to try to make a loan of this size. Okay, so there's, in part of the ongoing management of these institutions, there's monitoring goes on all the time. Ones we've talked about mostly is that the institutions themselves report the data that is required by law and regulation to the regulator. But the regulator themselves often will visit institutions to actually meet on site, examine their systems, and and carry out their own investigations. So that's not uncommon to have the regulator come in and visit the bank to ensure that things are going along as they should. And just like we mentioned before, when you're starting your bank, you have to have an auditor that's approved. Every time you have an audit report on your bank, and typically you have to have one at least annually for your annual accounts, a copy of the auditor's report automatically gets sent off to the regulator for their looking at it, so they can make sure that things are going fine. Okay, any questions on that before I think it's about the last one. Any questions? Okay, I think that's the last one, apart from this one. Yeah, so that's the last one. Now, I did promise you, let me see here.